Let's assume our company needs financial capital to fund future growth, but does not want to borrow. Loans and bonds require companies to make regular payments to their creditors. Failure to do so can cause significant problems through default, and the company's shareholders may lose control over the company. These issues can be a big concern for new firms or firms with uncertain future revenues. A firm that doesn't want to borrow may instead raise money by selling equity. A firm is not obligated to make regular payments to equity shareholders. Whereas failure to make a coupon payment to a bondholder can trigger default and in some cases administration or bankruptcy, the firm does not face a similar consequence should it not make payments to equity holders. The first time a firm sells equity, it does so through an initial public offering or IPO. These shares are sold on what is called a primary market. The primary market is the segment of the stock market where freshly minted shares are bought from investment banks working for the firm. After the IPO, investors may trade these shares on a secondary market, which is typically a stock exchange. In a secondary market, shares trade between investors. Like all securities traded on a market, share prices are set by supply and demand. A company may raise capital by issuing shares after an IPO. The sale of new shares in the secondary market by a firm that has already undertaken an IPO is called a seasoned equity offering, or SEO. Equity holders benefit from owning shares in two ways. First, a company may make a dividend payment. This is a payment approved by the company's board of directors that is made to every share. A shareholder gets a total dividend proportional to the amount of shares they hold. On the declaration date, the board of directors authorizes a dividend. Shares continue trading on the market and are called cum dividend. That is, the share price includes the value of the dividend. To qualify to receive the dividend, a shareholder must purchase the shares before the ex-dividend date and hold the shares until the record date. On the ex-dividend date, the dividend payment no longer trades with the share. As a result, the price of the share drops on the ex-dividend date by the market value of the dividend payment. Dividend payments are made on the payable date, which is also called the distribution date. Second, a company may repurchase its shares from shareholders. Those shareholders that sell back to the company get cash. Once the company successfully repurchases a share, the share's ownership stake is eliminated. As a consequence, the ownership stake for the remaining shares increases. Market forces essentially ensure that shareholders are equally well off whether they sell the shares or keep them. Company shareholders should prefer to get paid in a tax-efficient manner. Due to this, the tax regime is a large factor in whether a company pays dividends or repurchases shares. Dividends are treated as income in most tax systems. Repurchases result in a capital gain. In Australia, investor income tax rates are generally lower than those for capital gains. As a result, Australian companies favor dividends. In other countries, such as the United States, the opposite holds. Capital gain rates are lower than investor income tax rates, and companies favor share repurchases. The choice between issuing debt or equity falls to the board of directors, who are typically informed by the chief financial officer. Debt payments lower a company's tax responsibility to the government, leaving investors with more post-tax earnings. But the cost from a potential default can deter companies from issuing too much debt. However, markets may view the announcement that a firm wants to pursue a seasoned equity offering as a signal that the stock is overvalued. Markets may wonder why a company would sell shares if the stock price is going to increase. As a result, a company's stock price can go down on the announcement that it will issue equity. Companies trade off the benefits and disadvantages of equity and debt issuance when making any issuance decision.